Welcome back to Real Estate Economics webinar series. This week we're covering the topic, what are the financial markets telling us about housing market economics? In this particular section, we're going to look at some housing market related industry groups and see how the performance in those sectors ties back to housing market economics. If you recall in section 2, we've been using Morningstar industry groups compared to S&P data to evaluate capital allocations into these sectors and to evaluate the market's perception of their performance in this recession. Maybe look into some current trends and forecasts. This particular industry group is surety and title insurance. As you can see, this market, as the S&P trailed off, this market actually performed pretty well. We heard reports from across the country of communities and people with developments who all wanted to make sure their performance bonds and their completion bonds were in place. So some of these companies are actually generating reasonable premiums even as the recession was taking hold. A particularly interesting feature in this particular industry group is you can see the peak periods in 2009 and 2010 sync up entirely with the federal and state tax incentives for housing. The market really anticipated higher transaction volume here, responded accordingly, and then dropped back pretty quickly when that ran its course. We've got a little uptick in the latest period, so we'll have to see how that plays out in terms of actual market activity. This is mortgage investment. Now this covers not only big originators, but also companies that handle mortgage investments, buy and sell mortgage pools and this sort of thing. As you can see, this had a very bumpy history coming into the recession, and then sort of moved in sync with the S&P 500 through about the middle of 2009. Since then, we've seen a widening gap, so obviously investment capital is beginning to avoid this particular sector, and that avoidance seems to be increasing in its magnitude in the most recent periods. Now, we've been hearing reports about subpoenas going out to some of these lenders so that they have to improve their documentation as to whether or not they met agency standards to buy some of these pools, and so that spooked the market. And there's some other factors that we believe are hurting the fundamentals here, but this is a big performance gap to the S&P 500 and something we're going to have to watch very carefully if we're going to see a recovery in the housing market. Residential construction is this industry group. This includes all our recognized public builders. You can see that, believe it or not, this has not performed that terribly over the past year and a half. Certainly no worse than, say, shipping in our previous series, and actually a lot of other things. If you look through the 200 industry groups, you can actually see a few things that have done quite a bit worse in residential construction. I know that doesn't give us much uplift today, but there is some seasonality built into this, and I think what the recent prices of the entire group now are telling us is that it's going to be a subdued second half of the year, but we'll watch this carefully as we get towards the end of the year and into 2011, because we think there'll be much improved price support for this group over time. The next series I'd like to show is REITs, Real Estate Investment Trust. This is residential REITs, so what we're really talking about here is apartment owners and operators and the big apartment holding companies. Now, as you might have expected, if you look at the far left of this chart back in 2008, the market really correctly anticipated that apartment occupancy and apartment economic fundamentals were going to be very poor. We've certainly seen that many apartment communities have seen people move out. We've seen students move back in with the core household. We've seen seniors move back into the core household. In some cases, we've seen both the senior and the student move back into the core household, really to try to preserve that home ownership at the core level and leave a vacant apartment unit. So this particular industry group had its struggles, and you can see a huge gap between the performance of these apartment REITs really starting about the beginning of 2009 and running all the way through mid-year 2010. Now we think we have a significant change in fundamentals here, and what we're starting to see is, as people tend to be unemployed for much longer periods of time, they're much more willing to relocate, they're much more willing to move to a market where they find employment. They don't have a house there, and so where do you go? You're renting an apartment. Now, sometimes the REIT quality apartments are a little bit better than, some of the cheaper living accommodations you can find in some of these cities. But this is translating into improved economics for apartment owners across the country. This is actually, we think, a tremendous positive for not only the economy, but the housing market, because if the employment pool, if workers are mobile and are willing to move around, that goes a long way towards filling jobs and improving overall employment levels. So what do these industry groups tell us? Most of the housing-related industry groups have very modest growth profiles. I think that tells us, at least for the back half of 2009, the market's going to take a wait-and-see attitude on housing. The sentiment's very poor, as we recognize. A lot of people have low expectations, but in some sense, some of the expectations and performance levels don't get much worse than this. Mortgage rates, we recognize, are low, but credit standards are increasing. We've heard many, many stories from quality borrowers who are self-employed, who have gone to no end to provide documentation needed by much tighter underwriting standards. Letters are being written. People have really had to go the distance with some of these lenders. Now, if you're on a conventional 1099 and can prove your income, lenders have been very accepting of that, and we haven't heard of too many problems there. Credit availability, we recognize, is still poor. Might be an understatement. Terrible might be a better word. For builders and most small businesses, we think particularly in terms of small businesses that tend to buy a lot of homes. Small business owners like to buy homes when the market's good. But where does small business financing come from? If you look at small businesses, where do they get their money from? One, there's vendor financing. We think that's dried up almost completely. Two, there's bank financing. We all know that's dried up. Last, home equity loans. People have tapped into their home equity to finance business expansion. We recognize now that there's no home equity loans for these people now, so credit availability has really been cut off for small businesses, and that is a major source of home buying population. Trends in worker mobility, we talked to this just a little bit with the apartment REITs. This is really going to help shape the next housing cycle. People are going to become increasingly willing to move. They're going to become willing to take lower paying jobs, unfortunately is how it looks, go to where the work is. Now this has far-ranging consequences, because states that have poor business environments are seeing and are going to continue to see outflows of workers and businesses from their states, and states that have positive businesses, Texas is a perfect example, are going to feel big in-migrations and huge improvements in their economy. So this is really a significant public policy matter. It's really going to force some discipline into the states, which frankly has been long overdue. That's the end of part 3. We've got one more section today, so please join us for section 4.